Hello, everyone. Good evening. Let me know if you can hear me. Let me know if you can see me. Let me know where you're watching from. Tell me your name. Tell me where you're watching from. Good evening, everyone. Let me know your name. Let me know where you're watching from. Okay. I want to also monitor things from my end. So if you can hear me, let me know you can hear me. Good evening, everyone. Can you see me? Can you hear me? I need your confirmation so we can start right away. I'm waiting for you in the comment section. Can you see me? Can you hear me? So we can take it up from there. Let me know where you're watching from. Thank you, Hayobami from Lagos. Good. Thank you, Hey and G. Good evening to you. Good evening. If we can, Obi, watching from Lagos. We seem to have Lagos people in the building tonight. Okay. Thank you, if we can, Obi. Thank you, Hey and G Prince. Thank you, Hayobami. So tell me where you're watching from. Tell me your name. Tell me where you're watching from before we start today's webinar. Oh, this is Ife. Oh, Ife is A&G Prince is from Ife. Okay, so somebody from another region. All right, good. But we have two people watching from Lagos. Okay. All right. So we'll go straight to today's webinar without wasting time. We'll allow others to join us. Yeah, you can see and hear me. Thank you very much. So I can also hear you. I can also read from you, even though I can't see and hear you. So we'll go straight to today's webinar. I would love to make time for questions tonight. So I'm going to be very brief with today's webinar so that a lot of questions can come in. And in the process of answering those questions, I'll also be talking about some of the things I have in my slide. Thank you very much. Thank you, Ocheme Julius. Thank you. Watching from Jaws. Wow. Thank you very much. It's good to have you here. So tonight we're going to be talking about 10 mistakes to avoid in the Nigerian stock market. Now, if there are no mistakes in the Nigerian stock market, there wouldn't have been need to talk about mistakes people are making. So it's obvious that people make a lot of mistakes that makes them either lose opportunities or makes them lose their hard-earned resources in the stock market. Should this be? No. Can it happen? Yes, it can happen. But should it always reoccur? No, it should not always reoccur if you're well informed and you know what to do. And that is why we are here tonight. So let's move very quickly into those slides and we'll talk about it so that I can take your questions tonight. All right. So these mistakes are, I'm talking about 10 mistakes, and they are not limited to this thing. There are still much more, but this will still serve as a good guide for you. All right. So let's move from here. Number one, what is the number one mistake you're making? Thank you, David from Ogun State. Oh, wow, from Ogun State. So, what is the number one mistake you're making in the Nigerian stock market? The very first mistake anyone can make in the Nigerian stock market is when you're investing without a plan. Now, what do I mean when I say you're investing without a plan? Imagine that you drove off the house in the morning and you don't know where you're going to without knowing your destination. You just keep driving around and around from one street to another. You enter the portals, you enter the express. You just keep going around and around. You will never arrive anywhere. Why? Because there was no destination in the first place. The same thing in the stock market. If you're investing in the stock market without knowing your why, if I talk about knowing your why, it means the reason you are investing. Now, are you investing because you're planning for retirement? Are you investing because you are planning to save up for your children's school fees? Are you investing for long term? Are you investing for short term? Are you investing for dividends? Are you investing for passive income? Are you investing for capital growth? You need to know why you are investing. The reason why you want to invest determine the kind of stocks you buy. So you don't just jump into the market, stock market now, and just pick stocks randomly. You might pick these stocks and it might not align with your goal. So you want to know why you are investing. So if you are investing because maybe you are investing for your kids, you want to look for stocks that has growth potentials. Maybe not too expensive at the moment, maybe they are still penny stocks, or even if they are not penny stocks, but you want to look for stocks that they continue to grow so that as these children are growing, the stock is also growing along with them. Are you planning to to invest for retirement? You are looking for solid stocks that are already stable. That even if it looks like there's volatility in the market generally, is not going to have a strong effect on these stocks. Imagine if you are buying Dangote cement now, it's already a solid stock. Now, please take note that all the stocks I'll be mentioning during this webinar, they are not stocks recommendations, they are for educational purposes. So I expect us to also make our own research when we're taking our decisions. So let me continue. So if you are investing for dividends now, you want to look at stocks like Zenith over the time. It has been stable, paying dividends, and it has been stable. So the reason why you're investing determine the kind of stocks that you can buy. So I will move quickly from that place. I said here that let your portfolio mirror your goals. Your portfolio should look like your reason for buying those stocks. Your portfolio should look like your plan, your goal. Let your goal and your portfolio look alike. So if you're investing for one thing, let your portfolio look like that. If you're investing because you want to get quarterly dividends, let your portfolio look like that. For instance, there's a particular, yeah, we have two stocks in the Nigerian stock market that pays 4 times in a year. So if you're the type that you're looking at getting consistent dividends in the stock market, stocks like NIDF, I'm not going to mention the other one so that you don't take it as a stock recommendation. So because of that, you want to look at your goals and the stock you want to buy. Let me move quickly from there. Thank you, Steve from Worry. That's another place, another state where we can many questions tonight. Another mistake people make in the Nigerian stock market is following the crowd. What I mean by following the crowd? Have you seen a sheep crossing the road? Once a single one takes the first step, what do you notice? The- Every one of them follows through, even if a vehicle is coming. They will just follow ignorantly. Are you the type that buys stocks because your friend said this stock is okay? Are you the type that you watch different videos, you're following 10 people giving different stock recommendations? So before you know it, your portfolio is full of different stocks that does not even align with your goal. So are you the one that has the ad mentality, just like the sheep? Once one steps onto the road, the rest of them follows. Are you just following different mentors, different social media people, and just picking stocks randomly? So this is one mistake a lot of people make in the stock market. And what happens is, now imagine that today is 30th August now. Let's say, for instance, I mentioned the stock and I say, okay, this stock is a buy. Somebody that is watching, let's say at the end of September, ask about the stock and feels that that stock is a buy. But the matter is, for those of us that bought immediately, what was our entry price? Will the entry price in August be the same as the entry price in September? So that's the danger of just following one stock is good, one stock is good. It might be good truly, but is it at that entry price? So you don't just want to follow different stocks. You don't just want to follow people mentioning stocks all around. You want to do your research. I'm still going to do our research. So you don't just want to follow others to buy who leads to poor buying what others buy often leads to poor entries. So when others have bought just a particular stock, let's say like 400, the stock is already at 1,002. Is it still a buy? It might be a buy, but at the same time, it might not also be a buy. So you don't just want to follow the crowd. Another one is trend fades. Losses can occur when popular trends diminishes. Now, take for instance when the insurance around that July, everybody, 10% today, 10% tomorrow, tomorrow. A lot of people started buying insurance. The matter is, even though a news came out and it favored the insurance sector, is it all the insurance sector that has good fundamentals that you can put your funds? Few days after that news and people bought those stocks, few days after, all those stocks were on bids, which means people that bought those stocks were now ready to sell. Nobody was ready to buy, and they were already at loss in some of those insurance stocks. So you don't want to follow the crowd. You want to do your own research before you buy any stock. And I wrote here that remember that the ad can lead to the slaughterhouse, which means that if you are just following the crowd, you might just be in for losses. So think independently. Think of why you bought a stock. Think of why you want to invest in the first place. That is what is going to help you to make your research before you make purchase of any stock. So think independently, guided by research and not noise. Let me check our previous slide. I have something that I want you to remember. Yeah, I said, remember, before buying the next stock, pause and ask, what am I investing in? Ask yourself, what am I investing in? Why am I investing? For retirement? Because of school fees? For long term? For short term? For dividends? For capital growth? This will help you to make a decision. Now, I have an express video that can help you to make your decision in relation to this. So this particular slide is a complete video in one of my YouTube. So just, okay, I think I'm going to just look for that before the end of the webinar. I'm going to look for the link and post here so that we all can go and watch it. By the time we watch it, we'll live with clarity as touching our goals. So we'll know how to invest properly. So I'll move from there and go to our third reason. So having talked about not following the crowd, I said you should do your own research. So from me, I said ignoring fundamentals. So one of the mistakes you'll be making in the stock market is when you ignore fundamentals. So when we talk about fundamentals, I'm sure that some of us, we have had fundamentals, sentimentals, technical analysis, and you're wondering, so what, when they say fundamentals, what does this fundamental analysis even mean? Now, when you're talking about fundamental analysis, imagine that you want to buy a house or a car, and you saw the body of the car very clean, very neat, good interior, but no engine, but bad engine. What does that mean? Irrespective of how good that car looks, it means that it can't drive you for too long. It has the body, fine, but it doesn't have what it takes to carry it for a long time. What about a house? Imagine that you want to buy a house and it has good interior, well painted, good zinc, everything, good furnitures, but the foundation is not solid. How long can you live in that house before collapsing? So when we talk about fundamentals, fundamentals is what drives it, is the real foundation, is the engine of that stock. So if you don't know how good the fundamental is, now I'm relating it with the engine and the foundation now. If you don't know how solid it is, you might just crash in no time. So now, talking about fundamental analysis in the markets, what do you have to look at? Investors often overlook crucial financial indicators. And what are those things you want to check in fundamental analysis? You want to check your balance sheet. That's the company's books now. You want to check the financials. You want to check the cash flow. You want to check the income statement. Now, when you check these three, what are those things you are looking for? I'm going to be mentioning it, all this, even though it's not limited to this. You want to check their revenue. Are they making sales from one quarter to another, from 1 year to another? You want to check their past 5 years. You want to check their past 1 year, quarter one to quarter two, quarter two to quarter three to quarter four. Are they making good sales consistently? If they are making sales, is it increasing? So you don't want to make 10 billion today and the following quarter you are making 7 billion. That tells you that something is wrong. You want to check what exactly happened. Why is the revenue reducing? When I talk about revenue, I'm talking about sales. Thank you, Dauda, from Thank you, Dauda. Thank you, Adams from Lagos. So as I was saying, you want to check their sales. Is it increasing or reducing? Now, you cannot use that independently. If you are checking their sales, you also want to check their profits. Let's say, for instance, in quarter one, a particular stock, a particular company made 10 billion in sales, and in profits, they made, let's say, 4 billion. In quarter two, let's say they made 14 billion, but only 2 billion in profits. Now, that is questionable. Why? Because they are making more sales in quarter two, but lesser profits. So you want to check, okay, it's true their sales is increasing, but why is their profits reducing? So you want to check their sales, you want to check their profits, you want to check if their debt is under control. You want to check if their debt is under control. So you want to know if they have, you want to know how credit worthy they are. You want to know if they can pay their debts easily. You want to know that if after paying their debts, they are able to, they still have profits enough even to give you the shareholders or even invest back into the business. So is it that all the profit they are making is going back into repayment of loans? If all the profit they are making is going back into repayment of loans, then that's questionable. So these are the ways you check the engine. These are the measures you use to check the foundation of those companies. Is there free cash flow? Do they always have cash? That's what you mean by cash flow. Is cash coming in and going out. So these, although not limited to this, are the each time you want to buy a stock. Check the fundamentals, which I know you remember these. Like check the engine, check the foundation. Don't just buy a stock because it appears cheap. It's 2 naira. So you buy 1 million shares. It's 5 naira. So you buy 1 million shares. No, that is not how it's done. There's no law that says every 5 naira stock must become 15 naira stock. A 5 naira stock can even reduce to a 3 naira stock. So you want to check your fundamentals. And remember that when you ignore fundamentals, you are gambling. You're just gambling, money more. So don't invest and start praying that, oh, I pray that this stock goes up. That prayer doesn't work in the stock market. There is no hope strategy. You don't hope that it goes up. Hope is not a strategy in the stock market. You have to check your fundamentals. And true wealth is built on strong fundamentals. All right, so let's move to the next one. Another one is, thank you, Abubakar from Shokoto. Another one is not diversifying. Now, when you have your portfolio and your portfolio is, you have single sector or a few sectors in your portfolio. Let's say, for instance, you are invested in banking stocks and just okay, let's say banking stocks and oil and gas, just two sectors. So all the stocks, you have like 10 stocks in your portfolio, and you have Zenith, you have UBA, you have Fidelity, you have Access. So you are just invested in one sector. Now, the danger of that is that if a news should hit, if there is a news and is not in favor of that particular sector, your portfolio is going to be affected greatly. So you are just invested in two sectors or maybe just a single sector, and probably the portfolio has been doing well. But for any reason, if there is a news that affects that particular sector, your portfolio is going to feel it. Take for instance, this year, there has been so much move in the oil and gas sector. In fact, if you are not careful, if your portfolio is more concentrated in the oil and gas sector this year, it's not likely you have made so much gains, so much profits this year. Now, so that's the way you do it. You don't just, now, it doesn't mean that the oil and gas sector is not good. No, it doesn't mean that it's not good, but it has its own time. Their own time is still coming. So what if you need funds at the moment and you're already in minus, you're already in losses? What do you do? Because most of the stocks that you have in your portfolio, they are just one sector, and you can't afford to pull out funds from those sectors just because you're in losses. So you don't want to put all your stocks in one sector or maybe just two sectors. You want to diversify. Don't put your eggs in one basket. Split it. We have banking sector, we have consumer sector. In banking sector, we have Zenith, we have GT Bank. Of course, not limited to this. We have in consumer sector, we have USCN, Dangote Sugar, telecoms, technology, you have MTN, you have Champs, agriculture, you have Presco, you have Okomu, oil and gas, you have Haradel, and so on and so forth. We have the industrial sector, we have Dangote Cements, you have Boa Cements. So don't put all your funds in one sector. You want to diversify. I wrote here that diversification does not mean that you will never see losses. Just like I said, if you are invested in these 5 sectors, most likely, or maybe not, in oil and gas, you are not making so much profit yet, or maybe you are even in a loss. But the matter is, let's say you're invested in 4 sectors. Whatever loss you are making in one sector, the remaining 3 sectors can cover up for that loss for the meantime. So your portfolio is not even feeling the effects of a loss in just one sector. So you want to diversify when you are investing. Now let's move further. Having talked about diversifying, I also want to talk about over diversifying. Why lack of diversification is dangerous, like I said initially. Why lack of diversification is dangerous? Because I just told us that diversify. But on the other hand, over diversification can also weaken your portfolio. So when I talk about over diversification, what does this mean? One, let's say for instance you have just all banking sectors. You have Zenith Bank, you have UBA, you have mention some of those banks for me again. Zenith, UBA, Fidelity. So you have just all banking stocks. Yes, you have 10 of them. In the previous slide, I told you that not diversifying. So when some of you diversify, but when you now diversify, you just buy 10 stocks in one sector instead of going and buying different sectors. You are buying 10 stocks. Thank you, Access Bank. You are buying 10 stocks in one sector. But now, over diversification now means that you are too exposed. You are too exposed to one sector. So you have all banking stocks, you have all oil stocks, you have all industrial stocks. If anything happens to that particular sector, it's going to affect you. Apart from that, another thing with over diversification can do with the units. Let's say, for instance, you just have funds enough to buy, let's say, like 5,000 units of stocks. Let's say you just have 100,000 naira. Now, 100,000 naira does not, when I say diversify, I'm not saying go and put 20,000 naira in oil sector, 20,000 naira in industrial sector, 20,000 naira in which other sector now? Food sector. No, 100,000 naira is not a kind of fund you want to split. So you don't want to split your funds so much that at the end of the day, even a significant growth in that sector will still not, even when you have 100%, it will still not affect your portfolio. So you have 20,000 in Haradel, 20,000 in USCN, 20,000 in UBA, 20,000, let me see some of those stocks that we mentioned earlier, 20,000 in Presco. If your Presco is even doing 100%, just because maybe you're only able to, with 20,000 naira, I'm sure you might not be able to get more than 15 units of stocks. So you don't want to have 15 units here, 100 units here, 1 unit here. So what do you do in that case? If it's a banking sector with 100,000 naira, you can start with one sector. So let's say you want to invest monthly with 100,000 naira, invest in banking sector this month. The following month, invest in oil and gas. You can set a target for yourself. With my first bank, with my banking sector, I want to get to 100,000 units. So with your 100,000 naira the first month in banking sector, the second month buy in oil and gas sector, the third month buy in the food sector, the fourth month go back and buy in your banking sector. Don't spread across all the sector before coming back. You want to have reasonable quantity. Once you have checked the fundamentals, that was why I talked about fundamentals initially. Once you have checked the fundamentals of those stocks, you want to keep on what you have. You don't want to have scattered units in different sectors or even in the same sector. You don't want to have it scattered. Keep up on one sector. Keep up on one stock, I mean, I beg your pardon, not on one sector. Keep up on that one stock. So let's say, for instance, you want to invest in banking sector. You can just pick two. Fine, there are about 10 or maybe 10 banks: Fidelity, UBA, Zenith Bank, GTB. It doesn't mean they are not all good stocks to buy. But the matter is, you don't want to split your funds across those banks. So decide on the two. Check the fundamentals. Check the reason why you are buying. Are you buying for growth? Are you buying for growth? Maybe you are thinking of Fidelity. Are you buying for dividend? You are thinking of Zenith. Are you buying for growth and dividends? You are thinking of GTCO. Do you understand what I'm saying? So your reason for buying those stocks, your own personal reason, will determine which of the banking stocks you want to buy. So when you buy one, you want to keep up on it. Instead of buying GT, UBA, Zenith, First Holdco, you can decide, let me buy one or two. Once I get to 10,000 units, once I get to 100,000 units, once I get to 1 million units, I move to another sector. So you want to go to Haradale. Okay, I want to buy 5,000 units of Haradale. I want to buy 10,000 units of Haradale. While maybe for the first 3 months, you spread across three sectors, the next 3 months, you can decide to keep up on those three sectors alone. I hope you understand what I'm saying. Thank you very much, Lincoln. You said it very insightful. So if you are finding this informative and insightful, let me see you in the comment section. Let me know how you feel right now listening to this. Are you getting educated? Are you getting understanding? Is it insightful? Let me see us in the comment section. Let me know how much information you're getting in the comment section. I'll be waiting for your comments in the comment section. All right, so let us move. So I said, what happens when you are overexposed to different sectors? To one sector now is that one, let's say, thank you very much. Anini, he said, I'm getting value. Yes, thank you very much. So let me know if you're getting value in the comment section. So I said overexposure to one sector. So for instance, I said, let's say you bought just banking sector and you now diversify in banking sector. You know, the other time I was saying not diversifying. When I said not diversifying, now it doesn't mean that when you now want to diversify, you now diversify in one sector. You are looking at different sector. So what happens when? Thank you very much. Said Dalda Haba. You said very insightful presentation. Thank you. Thank you, Fan Clean. Good information. Thank you very much. So let's move. So the risk to overexposure. So what happens is when you diversify across a single sector, you risk exposure. You stand at the risk of exposure. Why? Because significant move in the stock does not significantly move your stock. Now, what do I mean with this? If there's no significant move in that sector, oh, sorry about that, the lights will be restored in a minute or two. Now, if there's no move in that sector, it's going to weaken your portfolio. But if you are diversified across sector, the other sectors can still be helping your portfolio. Another one is when you over diversify, let's say you have like 30 stocks. I know there are some people that they have like 30, 40 stocks in their portfolio. Now, how do you track or monitor 40 stocks? How do you begin to check fundamentals of different 40 stocks in your portfolio? So if you have two in one sector, two in another sector, two in the third sector, two in the fourth sector, one in the fifth sector, and you heap up the units on those stocks, so that is enough. Instead of you spreading, buying different stocks, and if any news hits that sector, then you fall into a problem. So if there's no significant move in that sector, let's say you have 10 banking stocks. If there's no significant move in that sector, your portfolio is going to be weak. And like I said also, that it's going to be difficult for you. You have 40 stocks. How do you begin to track and monitor 40 stocks that you have in your portfolio? So keep up on the good ones. Even if your portfolio looks scattered at the moment, you want to check again. Now, I didn't introduce myself at the beginning of the webinar. Some of you you know me as Coach Benita, and what I do is that I'm a portfolio builder. I help people build their portfolio. So you have like 40 stocks in your portfolio and you want to reduce to 20, which 20 should go for the remaining 20? So we want to look at it and check it together, but I do this through my one-on-one section. All right, let's move. So what happens is also that your portfolio loses focus. 40 stocks in one portfolio, everything is just scattered around. You have 5 insurance stocks. In fact, we have about 15 insurance stocks. Some people have about 6 of them, 8 of them. Yet they have other sectors that they don't even own. And if there is something big coming in that sector, you also miss out of it. So I said expand your horizon. Don't just stay in one sector. We have banking sector, we have consumer goods sector, we have industrial sector, technology, agriculture, aviation. We have so many of them. Even apart from banking sector, we have other finance sectors that are not even banking sectors. We have insurance sectors. So you want to look at the ones that have strong fundamentals, then you sit there and continue to heap up on it. I said remember, diversification should protect you and not dilute your profits. Diversification should protect you. So when I say spread your risk, it should be for your protection and not the other way around. So it should not be that you have all the units of stock scattered. 50 units here, 1,000 units here, 200 20,000 units here, 5 units here. You want to build a solid one, and another solid one in one sector, one or two, another sector, solid one or two, and that is how you have a strong portfolio. All right. Another mistake people make in the stock market. Please, I want us to begin to write our questions, because like I said tonight that I really want to answer questions. I know people have a lot of questions. I want to answer questions tonight. So in the course of answering those questions, I may have to go back or talk about certain explanations about some of these mistakes. That's why I'm very brief with all the slides. All right, timing the market. Now, a lot of people feel that they are looking for the best entry price. They want to buy when it's low, when it's deep, and they want to sell when it's high. But the matter is, will you always know when it's deep? Will you always know when a stock gets to its highest? At the beginning of the year, I think, okay, there was this particular stock, TIP, that was around maybe 1 naira 70 kobo to 2 naira 70 kobo or thereabouts. And this stock rose from that price to 17 naira. The matter is, for some people in the market, when it moved from 1 naira 70 kobo to let's say about 5 naira, 6 naira, that was how much? That was like 300% gain. Some people will exit the market, not knowing that this stock is still going to 17. Now at 17, some people will have felt like, I should sell at 17. But the matter is, how will you know if the stock will still move from 17 to 20? You can't time the market. You are not the only one in the market. So wanting to buy absolutely low and selling absolutely high is not so realistic. And that is why if you are in the market, you have to play the long-term game. Now you can I said earlier that when you want to invest, know your why. If you're investing long term, you know. If you're investing short term, you know. So when I say short term, it means that you want to invest for a short period of time. Let's say as early as buying today, selling tomorrow, to about 6 months or 1 year. Some people have different time periods for this short term. For long term, you're looking at say 5 years. Some people call 3 years long term. I call that medium term. 3 to 5 years, medium term. Now, from 5 years upwards, I call that long term. But people have this thing is not fixed; it's relative. So people have different time zone and time periods. They call short, medium, and long term. But you know what it is. Either it's 1 year or 2 years or 5 years. You know the number of years. Forget about if it's long term, short term. You know it's 4 years. You know it's 5 years. You know it's 2 years. You know it's 6 months. So if 6 months, you can tell yourself, my 6 months is short term. So you know in the next 6 months, I want to buy this stock and I want to sell in the next 6 months. So you don't go and buy what others are buying, what a long term, somebody that's taking a long term position for the next 10 years is purchasing. Now, I usually advise that even if you're a trader, now traders play the short term game, investors play the long term game. Let me know in the comment section. Are you a trader? or you're an investor. I just told us who a trader is now and who an investor is. A trader, they play the short-term game, the investors play the long-term game. So let me know in the comment section, are you a trader or you're an investor? Let me know those I'm talking to. So now when you come into the stock market, is it for a short term? Is it for a long term? So you don't want to time the market and believe that, okay, I know when the market is going to be low. Now, there was a particular stock I bought earlier. Was it earlier this year or sometimes last year? And I bought a few units of those stocks, and I was hoping that, okay, when I have more funds, I'm going to hip up on this particular stock. And I was just hoping that by the time I have so much more funds that maybe the stock will drop. This stock continued to move without giving us room, without giving us that break. It kept moving from time to time, from about 400 to about 1,005 or thereabouts. That stock moved. It didn't give us break even to buy. So imagine that I was timing the market. I remember that when I was recommending that stock at 700, I was telling the person that, okay, let's see, it's May and it may not. Maybe it can even come to 600. That just position yourself. Unfortunately, that stock did not drop to 600. It kept moving. That's why if you are playing the long-term game, both, somebody said an investor, and that one said, I'm a seasoned trader, okay? Abaka said an investor. Okay, so I know that I'm talking to both investors and traders tonight. All right. So if you think you want to time the market, especially if you're a long-term investor, if you think you want to time the market, you might be wrong. So in such situations, even if you think you can time the market, and if you're timing the market, you know that you want to do your technical analysis. Now, even if you want to time the market, you might even want to split. Another one method I use is I split my funds. When I feel it's going to be low, I split into two. I buy now because I'm a long-term trader. So I buy now and I wait. When I feel, okay, this stock should drop to this price at this time, the remaining half of the stock, I keep it till then. So by that time, if it drops, I buy and I average down. And sometimes, unfortunately, it might even move above the price I bought initially. But that's a calculated risk for me. I don't miss out in any way because I'm playing the long-term game. So even no professional, like I said, that avoid perfect timing. Buying low and selling high is extremely difficult. Is it possible? Yes, it's possible. Have I done it? Yes, I've done it over and over. But is it always accurate? No. We cannot always be accurate. No one consistently gets the timing right, not even professionals. Because if we always get the timing right, it means we'll always continue to make money and we won't have to make mistakes at all. So does it mean that we'll still not make mistakes in the stock market? No, but our mistakes will be limited. Doesn't mean that we'll not make profits. Doesn't mean we'll not make profits in the stock market. No, but we'll make profits, but we might not always be able to buy at the deepest and sell at the highest. But even if it's in between, we'll still have that profit. And now when you are playing the long-term game, then that's where you have it very sweet. I'm going to be talking about explaining more of that very soon. Thank you, Adams. He said it's awesome. Both and both. Yes, you're both a trader and an investor. So now for traders, when you want to buy stocks, what you want to do is check technical analysis and price action. Then for long-term investors, you want to check your fundamentals. Okay, so let me move quickly. So I said buying low and selling high is extremely difficult. I've talked about that. Not even professionals can tell you the exact time. We might be able to predict maybe from day to day. We might be able to predict because of history. Maybe we have looked at the past 5 years, what has happened. We know that, okay, this is a season. This season you get able to buy at discount. This season is a bullish run. This season is a bearish run. Just like now we are in a bearish season. Between now and November, you still have opportunity to buy. This is a buying period. Some people will be seeing their portfolio dropping this period because people are selling off. And people are selling off because of many reasons. Children are going to resume school. Some people have children overseas. I'm not talking about 1 million, 2 million. People are withdrawing 20 million, 50 million, 100 million because their children are overseas. So the school is resuming very soon. A lot of things are happening. Some people are they are panic selling because they feel that their stock prices is reducing, and they just feel like, oh, I don't want to continue to make losses, and they sell ignorantly. So you just see prices continuing to drop in this period. But what do you do as an investor? You buy. At least for everyone that is selling, before there is a transaction, for anyone that is selling, it means that there is a buyer. So before a transaction can occur, there must be a buyer and a seller. So those that are selling, it means some people are buying. So investors are buying. Investors are buying now. So between now and November, you have opportunities. You just be seeing some stock prices dipping, some stock prices not moving. It is giving you buying opportunities. But by January, February, when the first quarter result is out, you now see that everybody is rushing to buy. So they release the first quarter results, and people see that, oh, these people make profits. That's when everybody jumps into the stock. I begin to see the stock rally. Now, because it made 10% the first day, 10% the second day, then you enter into it. And after making 10% the third day, the fourth day it begins to dip. Why? Because you joined the herd, like I said the other time. You joined the crowd. So when people are buying, like I said, that when others are selling, it's a time for you to buy. So this is a good period between now and November, even December is a good period to heap up on your portfolio if you are an investor. And even if you are a trader, let's say you have like 6, 7 months, if you fund your portfolio now, by January, February, March, then if prevention that's if those stocks have good fundamentals now, January, February, March, you're in profits, you exit the market, you make your profits. Okay, so let's move on. I said, yeah, that practice regular investing, invest consistently. Now, some of the mistakes people make is that you invest in, you see a lot of people that invested in the early 20s, 2005, 2006, 2007, before this crash, the general stock market crash happened in 2008. Some of the people that bought stocks that year, even after the crash till now, they have not gone back to claim their stocks. They have not gone back to claim their dividends. They just bought those stocks and forgot about it. No, those are the mistakes we make in the stock market. I will go back to that. I don't want to go ahead of myself. So I said invest consistently. So you want to invest. If it's monthly, you can tell yourself, okay, 500,000 naira monthly, 1 million naira monthly. Even if it's 5,000 naira monthly, 1,000 naira monthly, you are better than someone that has not started, because the moment you start, it continues to grow, it continues to increase. It's better you start the journey than not start at all. Even if it's 1,000 naira, just start. Now, let me tell you the beauty of starting. When you start and you invest 1,000 naira, and you see that you are making more funds, more money, the joy of that, even especially when they are paying you dividends. Imagine that you just wake up in the one morning and you see the alert on your phone, and you're just wondering, which money is this one? Oh, is that stock that I bought? That joy alone wants to make you invest more. So it encourages you. So if either you have started, or you have started and you have been pulling out your funds, I want to encourage that just continue. Don't stop. Pick a time for yourself. Okay, I want to do this monthly. I want to do 10% of all my income. I want to do it anytime money flows into my hands. I want to do it when I have any loose fund. I want to do it. I want to invest first after getting my salary, after getting my income, before I do any other thing, which is the best. Pay yourself first. You want to invest first before you start to spend. Because by the time you begin to spend, I tell you, you almost exhaust that funds, because the moment the wants also increases. All right, thank you, Oladimeji Benjamin. Say thank you, coach, for the knowledge impact you're making on financial freedom. More blessings. Oh, more blessings to you too, Oladimeji. Oh, Adam said, what is number one mistake? Number one mistake is not knowing your why, when you don't know why you're investing. But this video is going to remain on YouTube. So after now, you might just want to go back and watch from the beginning so that you can benefit from it. You don't miss out on everything we have talked about from from the onset. All right, let me move very quickly because of our time. I said earlier that I want to take questions. Please begin to put your questions together. So when you are timing the market, what happens? You stand a risk of missing opportunities. Now, let's say a stock was at 27 naira and you were thinking that, okay, there's tendency for this stock to come to 23, and that stock might not even drop to 23. So if you are an investor, what do you want to do? I just told you what I usually do. What do you want to do, especially when you're a long-term investor? Invest. When you have more money, even if it drops after investing at 27 naira, if it drops below 27 naira, let's say it drops to that 23 naira that you were thinking it would drop to, and you have invested at 27 naira, look for more funds and average down. If you had bought at 27, let's say you bought 1,000 units at 27 and it comes down to 23 naira. If you buy another 1,000 units, that means you have averaged down. Your unit price can now come to, like, let's say 24 point something or 25. Do you understand what I'm saying? So if you're a long-term investor, another strategy I do, like I told you earlier, is split the funds into two. Buy now, then when you think the price can come down, buy the remaining half. So with that, either it increases or it reduces, it averages your units costs. All right. So I said waiting too long for perfect dip. So while you think you are waiting for the market to dip so long, unknowing to you, the market could just begin to retrace. Now, let me say this, that the stock market does not move in a linear progression. By linear progression, I mean it doesn't move straight. There is always a zigzag movement. So which means that when a stock has rallied for so long, there's tendency that it comes down a little bit. Just like I was mentioning the other time, I was talking about tip. When tip got to 17, it began to drop. And now because there was a news about the rights issue, tip dropped to like 12 naira, coming from 17 naira. But now, how does this benefit the long-term investors? Some of those people had bought at 2 naira, 3 naira, 4 naira. If you bought a stock at 4 naira and it's 12 naira, if it got to 17 naira and came back to 12 naira, you should not be bothered. So long it has good fundamentals. Don't forget that when I was talking about fundamentals, I said I used the illustration of the engine and the foundation. So long it has good fundamentals, stay in it. It's a matter of time before it returns to the 17 naira and even goes beyond the 17 naira. And another mistake people make is jumping in and out of stocks. You jump in because it's making profit today, you jump out when you're making loss. So when you jump in because it's making profits and you sell because it's making profits, the moment it begins to dip, you now sell. Then you now sell at loss. So you now say that the stock market is a scam. The stock market is not working. Everything is reducing. My portfolio is on red. Why? Because you don't know all these mistakes. You don't know you're making these mistakes. So you don't want to run. Oh, okay. I don't know if I have that in my slide, but just in case I don't have it, let me talk about it quickly. You don't want to move. You don't want to run after a moving train. If a train is moving, you don't open the door and run into it. You might just get crushed by that train. So what do you want to do when you see that a train has moved? Wait for the next train. Who knows? It might even be the same train that will get to the next destination and go back and turn. So which means that maybe you bought, I don't know why I use UAC and I use UACN a lot. I held one seminar very recently this month. And somebody was asking me in the comment section that I want to buy UACN. That can I buy UACN at 88? UACN was 88 at that time. Now, is UACN a solid stock? Yes. Good fundamental? Yes. But he said, I want to buy at 88. Is that a good entry point? At that time, no. But guess what? After I told this person no, that was on a Saturday like this, on Monday, that stock moved from 88 to 96. I watched this stock move from 96 to 100 and was it 106 or thereabouts? And in my mind, I was telling myself, now I told somebody, don't buy. Because this person's investment goal was long term. Now, that reminds me, don't forget I said, always know your why. Somebody that is on a short term at 88 could have bought and sold at 96. A 10 naira profit might not be a bad profit for somebody on short term. But for somebody on long term, buying at 88 is a no. That's why I said, always know your why. Know why you are buying. Know the time horizon, know your risk appetite, know your risk tolerance, know the time frame. I already have a video on all of this. Let me see if I can put that in the comment section now, so that after this, you all can go ahead and watch that video. Let me see if I can do that quickly, because I don't want us to miss out on that. So in that video, I talked about knowing about your investment goal, knowing your risk appetite, knowing your risk tolerance, knowing your age bracket, because your age also determines the kind of investment you can also the kind of portfolio you build. Your age bracket also matters. And let me, what are all those things now? Let's take it. Please type for me in the comment section. Let me list some of those in the comment section as I'm mentioning. Somebody should type for us. Now that's a link to that video. So please, after now, you want to go back and watch that video. Okay. Yes, I posted with Fem with Mayor, so you can pick it from there. So let me continue. Oh, should I have used this? Oh, let me see. Okay, but you can just go from there. Okay, that's fine. Okay, so like I was saying, you can list for me in the comment section. So some of those things you want to check when you're investing is check your goal. Why are you investing? Check your risk appetite, which means how much risk can you take? Check your risk tolerance, which means how are you able to manage a risk, peradventure there's a loss on the investment. Check your age. What you invest in, what you invest for your children is different for what you invest in as somebody that is about to retire. It's different for somebody within the age bracket of, let's say, 30 to 35. So your age bracket can also determine the kind of investments or even the kind of stocks that you buy. All right. Another one is the time horizon. How soon, how long do you intend to invest? 6 months, 5 months, 10 years, 20 years? All of those determine the kind of investments. Oh my God, this time is not waiting at all. Let us move. So I said, now when you're timing the market, oh yeah, I was talking about the UACN story. Yeah. So now when that stock got to 106, when that stock got to 106, then I saw that stock is now started retracing. It started coming down. As we speak now, I think USD should be about 73. Now, can you understand what I'm saying now? That don't move, don't run after a moving train. So that stock came back to like 73. As we speak, it should be around 73. In fact, if you are the type that understand price action, you should be able to get that stock for as little as low as 68. If you are the type that understand price action, if you bid for 68, there's every tendency that you'll be able to get that stock. Now imagine that you're able to get that stock at 68 and this person has bought at 88. So don't run. You see that again 10% first day, second day, third day, the fourth day. Don't go and put yourself as a sheep for the slaughter. Because I tell you, a stock that gain 10% first day, 10% second day, 10% third day, fourth day, what do you expect? Now, I think I watched somebody that was talking and one of the another coach that was talking about if you want to pick a stock, when you see it gain first day 10%, second day 10%, third day 10%, and in my heart I was like, Kai, these people have been misled. So don't run after it. It doesn't even have to be that stock. If you don't have the chance to buy that stock again, which one is the next stock to buy? Except you know that even if you buy and it dips, you are able to weather it, then that is fine. That means you have a high risk appetite and you have a high risk tolerance. It means that you can manage the risk on your investments. So if you know that you are the type that you cannot manage that risk, don't stress yourself. Let that train go. Thank you, Temod Consult. Let that train go. Wait for the next train or wait for that train to go and come back. If it doesn't come back, wait for another one. It doesn't have to be that one all the time. Except you know that you are going to stay in that stock, weather the storm together until you now move. Now let me share my experience. There was a particular stock that I bought, and after buying that stock started dipping. It dipped until I got to about maybe minus 20 something percent. What did I do? I tried to average down. Now, yeah, I think it's also more than 25%. Then I averaged down. After averaging down, I got to like minus 25%. All I just did was, because I know that it's not everybody that has funds to begin to pump into a single stock. So I just waited that when this stock returns to this, I will sell. Now, why am I selling? I'm selling because after checking that stock again, I realized that they don't have a solid fundamental. Is an insurance stock. They don't have a solid fundamental. They have made loss the first time, made a loss the second time, but I just decided that I'm going to buy this stock. And when I buy it, I know that when there is a good result, it's going to push the stock. So I bought it because I know that, okay, if this happened, it was a calculated risk. Now, there's every tendency that if there was no news in the insurance sector, I won't make a profit on that stock. But because of the news that came in in the insurance sector, I was able to sell above 100%. That stock moved from minus 25, 20 something percent or thereabouts to over 100%. And I sold. I sold not to return to that stock because that stock is not impressing me with their fundamentals. Do you understand what I'm saying? Somebody said, should I average down VFD group? I lose 31%, even though I bought oh, for long term. Yes, you can average down on VFD. VFD is about maybe 11 naira thereabouts. If you place a bid for 10 naira 90 kobo, you might just be able to get VFD. Now, why did I say you might average down VFD? Because they have solid fundamentals. That's why I said you can average down on VFD. However, like I said, as every stock I mentioned in my webinar is not a recommendation, it's for educational purpose, and I want us to also do our research. Now, this is something we need to keep talking about in every of our webinars so that we are not liable for any loss on anyone's investments. So please, after this, I expect us to also do our research. That's why we are teaching these things so that you can do your own research personally. So for the person that is asking that, can you average down? Yes, you can average down. And I can tell you that what happened to you was, I know the story of VFD. VFD was around like a 40, for three or thereabouts earlier in the year. And when they were going to do their 1 5 for 1, that means for every one stock you hold, they are going to give you five. Everybody started jumping into this stock. That let me know if that was your experience. Everybody started jumping into this stock. I was already seated in VFD at around maybe 40 naira or thereabouts. That stock moved from 40 naira to 96. Imagine it did over 100% in the space of one working week, in the space of maybe 5 working days or thereabout. And people kept jumping 10% today, 10% Thursday, 10% Saturday, 10% Thursday, 10% Friday. I knew that after all of that. Now, for so many people that bought that stock, now when yes, Adada said yes, exactly. Now, so that's why we keep having the seminar so that we can understand. Imagine that you didn't move after that train. Now it means that you'll be able to buy VFD now at 11 naira fresh. So just imagine that. Now, when I said 11 naira, because there was a stock split on VFD. So VFD did a 5 for 1 bonus, which means for every one stock you hold, they are going to give you 5 extra. And that was why a lot of people jumped into the stock. So now when they give this bonus, what they will do is they will split that stock. So let's say if the stock is a 50 naira stock, they will now that will now be 5 stock. That's 5 free stock plus that one you hold initially. They will now divide that 50 by 6. So I think in VF this case it was like 96 naira. So it will now be 96 divided by 6. So after then, I think the stock was about 14 naira or thereabouts, and it started dropping in the market. Why? Just because a lot of people already own this stock at a lesser amount and they are in profit, especially for those of us that bought when it was around 40. So our own unit price was small. It was less than 10 naira. Do you understand what I'm saying? So for you, when this stock was splitted, your unit price was maybe around 14 naira. That confirm for me in the comment section. So maybe your unit stock was around 14 naira or 13 naira after the stock split was done. So now, just because people were selling, there were now more sellers in the market than buyers. So it forced the price of VFD down just because of that bonus issue. So, but because you're long term, you can average down and just relax for VFD to gain? Yeah, 14. Thank you very much. So you just confirmed that it was around 14. Yeah. So just relax and wait for that stock to come by. So please average down on your VFD and relax. It's also a dividend paying stocks, so there's nothing to worry about. All right, our time is fast spent. So, like I said, when you are timing the market, you waiting too long for perfect dip, you miss opportunities. When you sell early with an intention to buy cheaper, now sometimes you feel like, oh, okay, for let me use that tip experience. For those that bought at, let's say, 2 naira, 3 naira, and that stock got to 9 naira. That's about 200% profit already. So some of them will sell at 200 at 9 naira, believing that every stock, there's no how. Stock does not move on a linear progression. When I mean linear progression, I mean it doesn't move straight. It's not a straight line. It doesn't move straight. It's not a straight line. Sorry, I'm trying to monitor things from my hand here. Okay, so it doesn't move on a straight line. It's always a zigzag movement. So when it goes to 9, some people will have just look at this clock that I have here. You see that is a zigzag, zigzag, zigzag. But if you notice from this deep, are you looking at my look at this clock? From this deep here, this deep is different from this deep. Now, if you look at this deep, oh, okay, please just stay focused. That light will be restored in a minute or two. So if you look at this deep now and you compare it to this deep, you realize that even after dipping so long, there's another shoot in the market. So there is always the stock market always moves in a zigzag direction. So for you, Mr. Dada, please average down. So like I was saying for the tip, before I forget what I was saying, like I was saying for the tip that so for those that bought at 3 naira and sold at 9 naira, they will have believed that okay, maybe that stock will come down to 6 naira and they will buy back. But that stock did not relent until it got to 17 naira. And the news about the rights issue came out. So people who already held that stock and qualified for the dividend for the rights issue began to sell. Why? Because they know that when they sell at 12 naira, 13 naira, 15 naira, 14 naira, they will be able to buy back at 7 naira. So when I say rights issue means that if you already hold the stock and rights issue is to be given, only those who already hold that stock as at the qualification date of that particular stock will get access to that, will get access to is it now? It's moved from 640 to 1050 and presently at 1020. Oh, can I check how much Okomu is? Okay, let me see if I can check how much Okomu is, but I'll keep talking and I'll see if I can assess my portfolio while I'm talking to you. So I'll just keep talking and I'll see if I can assess my portfolio. So I'll check how much Okomu should be around maybe 918 now or thereabouts. I wish I can give you a fixed price. Okay, so you know what's going to happen? 10 month, if you're on the WhatsApp group, just send me a message. Please, I mentioned just 10 months now. Please send me a message and I'm going to respond to you on that. It's a good time to actually average down on Okomu oil already, but I would like to help you with a price to enter. So just send me a message. Just check, drop a message in the WhatsApp group, in our WhatsApp group, if you're on the WhatsApp group, and I'm going to respond to you. Please, that does not mean that everybody should enter my DM. I am usually busy. I may not be able to respond. But I said you should send me a message because I want to respond to that. Okay, so let's move. So time in the market always beats timing the market. So when you think that you want to time the market, you want to wait till it's low or and sell when it's high, you might not always be accurate. So what strategy is better? The strategy that you can use is stay long in the market. Look at a stock like NACO. NACO used to be 2 naira in 2005. NACO is about 104 naira now. Presco used to be 18 naira, 15 naira, 45 naira. I think 45 naira in about 5 years ago. How much is Presco now? 1,480 or thereabouts. Even this Okomu you are talking about, within the space of 1 year, I think Okomu was still about 300 and something at the beginning of the year. Okomu sold as much as 1,100 and maybe 1,100 and something before it started dropping after they paid dividends. So time in the market, staying long in the market rewards more. So even if you feel like, okay, I've not bought this stock at the accurate time, so long you have checked the engine. Don't forget I talked about fundamentals. So long you have checked the engine and you have checked your foundation, average down or stay in that stock. Please keep tapping your screen. Keep sending your love if you really do. Just keep sending your love if you really do. Let me see your love flying on the screen. All right. So I said stop chasing perfect exit and entry. Build a strong portfolio instead. How do you do it? Do this. Invest regularly and compound dividends. I'm going to come to this dividend compounding. So invest regularly and compound your dividends. Patience beats prediction every single time. When I mean patience, I mean staying in the markets long, staying for 5 years, staying for 10 years, so long you have checked your fundamentals. Now, let me quickly say something because I'm not sure I have it in my slide. Just if I don't have it in my slide. Now, when I now say that stay long, let me check if I have it. I know there are more than 10 mistakes, but I know that okay. So since I have it, I'm going to leave that. Don't let me go ahead of myself. So now talking about compound, I said compound your dividends. It takes me to the next slide. Another mistake we make is neglecting dividends and not reinvesting dividends. Now, some of us, all the stocks we have in our portfolio, they are just growth stocks, they are just stocks that we are waiting for the prices to increase. None of your stock is a dividend paying stock. None of your stock can give you passive income. None of your stock can give you more funds to even reinvest. Somebody is asking, what do I think about VFD? Okay, please, you might need to watch this video again because I've talked about VFD. VFD has good fundamentals, so you might need to watch this video. I've talked about VFD already because personally, I'm even invested in VFD. But don't forget, I issued a caveat. This webinar is for educational purpose, so you want to also do your research. All right, let me move. So neglecting dividends and not reinvesting dividends. Now, I bought a particular stock in 31st of December or thereabouts. Yeah, so I named that stock A, so that before you rush and buy that stock and say that Benita gave you a recommendation, so I termed that stock as A. So I bought that stock as A at 1 million naira. Now, that was not the amount I bought. I'm just using a round figure for our understanding. So I bought the stock A in January. So that was 31st of December. So I wrote January for better understanding at 1 million naira. Now, this stock this year has paid us their first dividend and is going to be paying the second dividend. Together with the first and the final dividend and the interim dividend, they are paying us 15%. 15% of the amount I bought the stock. Now, this is a stock that in 2023, it paid 8 naira plus. In 2024, both the interim dividend and the final dividend was 8 naira plus. In 2024, it paid 24 naira plus. In 2025 now, it's paying 62 or 68 naira or thereabouts. Now, you can look at the increase in the dividend payouts from year to year. So if they are paying 15% of my own entry price, that means by next year, what am I expecting? I'm not expecting less than 30% if all things being equal. But I'm not going to use 30% because I want to be more realistic. I will stick with the 15% that I've seen this year. So I bought that stock 1 million naira. Like I told you that this figure is hypothetical for me. That's not the particular amount I bought. 1 million naira and they are paying 15%. I'm talking about the power of compounding your interest, now compounding your dividends. So after paying 150,000 naira as my dividends, I decide to put it back in that same stock. You may decide to put it in that stock and you may decide to use that amount to buy a fresh stock in another sector if you want to. The way you decide, the way you whichever stock you decide is left to you. You can buy either the same stock if you want to compound on that particular stock, or you might want to diversify into another sector if you have other sectors you're already looking at that moment. So those are the ways you can reinvest your dividend. So now at the end of the first year, in fact, I should even call that year zero, I have 1.150 billion naira. That's 1,150,000 naira. So I decided to reinvest. Let's say the second year is also 15%. Don't forget I told you that this is a particular stock that has rewarded about 100% in change in the dividends per year. So 2003 it was 8 naira plus, 2004 it was 24 naira plus, 2005 now is 68 naira plus. So which means that by next year, I'm not expecting 15%, but I'm going to leave it at that 50%. Now, at the same 15%, is going to give me 172,000 naira. If I had it to the initial dividend, to the initial closing I have in the first year, I'm going to have 1.3 million. For the third year, if I reinvest this my 172,000 naira, it means I'm opening the third year with 1.3 million. Now, if they still pay me 15% in the third year, it means I will have 198,000 naira plus. If I had it back, I'm going to have 1.5 million. If I if I'm given if I open the new year with 1.5 million with 15% interest and dividends again, that's going to give me 228,000 naira. If I had it back, that's 1.7 plus million. Now, if I bring this back again the following year, 15% on this, that's 262,000 naira. If I had it back in 5 years, I already have 100% only on dividends. Now, this is a stock that's given me over 200% already in 8 months. So if the stock has rewarded me over 200% already in 8 months, and in 5 years, it will have the dividends alone will have rewarded me 100%, which means if I divide by 5, that's like 20%. Of course, this thing is geometric, it's not arithmetic, if you understand what I'm saying. I'm talking about compound interest now. So it's not like it's 20% every year. But at the end of 5 years, the average will have been like 20%. So imagine that after 5 years, I will have 2 million naira just because I reinvested my dividends because I didn't spend it. So some of the mistakes people make in the stock market is that they eat their profits too early. You eat your profit too early. Sometimes you sell too early. Imagine that I sell this stock now. It means that both the 200% now that can even give me up to maybe 800% later in the future or 1000% later in the future, I will lose everything, including all the dividends. So selling too early, that's when you have a stock with solid fundamentals. Selling too early or not reinvesting your dividends can also be a mistake you are making. And also not investing in dividend paying stocks also. You want to balance your portfolio. When you have stocks that are actually growing your portfolio, you also want to have stocks that also pay dividends in your portfolio. So remember, dividends are not pocket change. They are a wealth building engine. So don't ignore dividends. I move to number 8. I'm going to brush quickly. It says emotional investing. When prices rise, this is what I was going to explain the other time that I said I would not move ahead of myself. When prices rise, and this was what happened to Abba. So this was what really happened to you. So this was your mistake, and I'm glad that you are here today because I believe you won't make such mistake again because you now have understanding. So when prices rise, greed pushes people to buy more. So 10% today, 10% second day, 10% third day, then you jump into the market thinking that the rally will never end. When prices fall, fear makes them panic sell, locking in losses. So imagine that if that I'm sorry I'm using you as an example now, but I'm sure that this will help you because after mentioning your name several times, each time you want to run after a moving train, you remember the way I called your name today. So imagine that now that you said you were in 30% loss. Yeah, now that you're on 31% loss now, and just feel like, okay, because you're on 31% loss, you don't want to continue losing your money and you sell. It means that you'll have made loss on that investment. So now, what are those mistakes? Don't run after a moving train. Don't rush after a stock that continues to rally. Give yourself some time. Wait for the pullbacks. If there's no pullback, let the sleeping dog lie. Let the moving train go. Wait for the next train. So what you don't want to do again is panic sell. So now that Dauda is in this meeting now, is in this webinar now, I'm sure he will not go and sell his VFD, that the unit price is 14 naira. He will not go and sell at 11 naira. So what is the strategy to deploy? Average down, buy more, that can drop the price from as much as that 14, if possible, to like 12. So the gap you have between 11 and 12 is already reduced. So with that, any move in VFD from 11 to 12 puts you on a break-even point. And after 12, you begin to make profits instead of waiting till it gets to 14 before you start making profits. Another thing you want to do is when VFD pays you dividend, you want to put in that money back again in your VFD. So don't panic sell now. Average down. The reason I'm saying average down is because it has a solid fundamental. Otherwise, if it's not a solid stock, sometimes you just have to count your loss, take your loss and move into another trade that can give you returns and return the losses you have made. So that's another thing. So I said don't run after a moving train. Okay, don't let me talk about this. I already talked about this. Fear and greed destroys your portfolio. Yes, when you have fear, that's panic selling. Greed, when you think that okay, it's going to give me another 10% and it's going to continue like that for the next 10 days, it will not continue. Stick to your strategy. Each time you want to buy a stock, I'm rushing now because of our time. Each time you want to buy a stock, remember why you bought it. Remember your goal. Each time you want to buy a stock, remember your goal. Remember your why. Why am I investing? Short term, long term, for dividends, for growth, for education, because I want to pay my children's school fees, because I want to build a house, because of retirement. Remember why you are buying. So when you remember why you are buying, it determines the kind of stocks you buy and stick to your strategy regardless of the short-term noise. Irrespective of the news, irrespective of the news should be considered. So you tailor the news to favor you. So irrespective of the noise now, let me not say news, irrespective of the noise, you want to stick to your strategy, your why. Always remember why. Always remember why you came into the stock market. And even before you sell, to always remember your why. Is it that that stock no longer fits your why? Is it that it no longer aligns with you? Always check before you even sell. Let me know in the comment section. How many of you know why you're in the stock market? Let me see in the comment section. Why are you in the stock market? What is your investment goal? Let me see in the comment section. Let me take some of those comments. Maybe I could just pick somebody and talk about your why. And I'm sure that when I talk about, just like I've talked about Dauda today, I believe that Dauda should remember this webinar and make good decisions, like I expect everyone also to make good decisions from it. All right, so rational decisions, based choices on data, not fear or excitement. So there's something I did right here, because I said I'm talking about 10 mistakes, but they are not limited to these 10 mistakes. So you don't want to leave your buying and selling to emotions. You want to be logical. Don't just act on emotions. Hey, it's rising. That's why before you invest, before you start investing, check your risk appetite, check your risk tolerance. Let me drop that link again. I'm going to drop that link again. I want everybody to copy that link and go and watch that video. It's a video I've made on all these things: your risk appetite, your risk tolerance, your age bracket, your time horizon, how all of these can affect your decision, how it can help you to make an accurate decision before you even start purchasing stocks in the stock market. So please go watch that video. It's going to help you. Yeah, if you said I am in the stock market for retirement, bravo, I love that. So when you're in the stock market for retirement, what you also want to check is, how old am I? Are you already in your 50s, 60s? Are you in your 20s and 30s? So it determines the kind of stocks you buy. So you don't want to go and hip up on certain penny stocks that is not going to rally, and you'll be needing dividends. Let's say you're already 60 and you know that, okay, between 60 and 70, I want to begin to withdraw stocks that will do well in 10 years. And within that 10 years, it will give you room for growth and stability. So you are not looking at volatile stocks. You are thinking of stability, solid stock, MTN, Dangote Cement, Aradel. Don't forget I said that these when I mention stocks, they are not stock recommendations. They are for educational purpose. So you are looking at Presco, you are looking at Okomu. Why? Because you are planning for retirement. You are looking at Zenith because you are looking at what can give you dividends and it's going to keep your money. It will not just crash overnight. Now, not even crash. Even when there's a correction in the markets, your portfolio is not feeling the correction. So if you are retiring for you are planning for retirement, you know what you are investing into. Why? Because you know your why. Thank you, Licolin said to build wealth over time. Very good. Oyegunle said to multiply my money. Very good reason. Because you don't just want to make money, you also want to manage your money and multiply your money. You want your money to work for you. You don't want to sweat all your life making money. You want your sweat money to make sweet money for you. Adam said, Coach, educate us on how to bid for a lower price at stock markets and the exact time of the day that the bids can take place. Thank you. Okay, I'll come back to that. But before I mention that, I might not even be able to tell you now, but I'm going to touch on it before we close. All right, so let me move. So I said, remember that the stock market is designed to transfer wealth from the impatient to the patient. I want us to type that in the comment section. The stock market is designed to transfer wealth from the impatient to the patient. So write in the comment section, transfer wealth from impatient to the patient. Why am I saying right? So that when you decide to be impatient, you remember, your brain can easily remember what your aunt typed, that now you are being impatient. You have typed it once that it transfers wealth from the impatient to the patient. So anytime you are tempted to be patient, you remember when you wrote it that the stock market transfers wealth from the impatient to the patient. So write in the comment section, the stock market is designed to transfer what? Wealth from the impatient to the patient. So I want to see you in the comment section so that you can always remember. And I'm going to move to the next slide that says, not reviewing your portfolio regularly. So, the other time I was saying that a lot of people bought stocks early in the early 20s, 2005, 2006, 2007. In fact, some, even including myself, I bought stocks around all these times until the market crash came in 2008. And after the market crash, I just stopped checking my stocks because everything went down. Of course, I was younger. 2008 should be like I was 18 years younger, right? I should be 18 years younger around that time. I was in maybe 200 level or 300 level, I can't remember. Maybe 200 level or 300 level. So when the market crashed, I just left everything. I just forgot about it. I stopped investing. Why? Because I didn't understand that even when the market crashed, it was a time to check the fundamentals and enter into the solid stocks at that time. Unfortunately, I didn't have that knowledge. I didn't have that kind of knowledge, the kind of knowledge I have now. I didn't have it at that time. Assuming I had this knowledge I have at that time, I would have made better decisions, but I left it out. I just let the stock right. I just left it. So I said no reviewing the portfolio regularly. So you don't want to leave your portfolio like a savings account. Your savings account, you might not continue to check because, if you have 10 million, your 10 million is there, maybe except for bank charges and a few stuffs. But outside that, at least you mean 9 point something million. You can't leave your stocks like that. You want to decide, okay, I want to check weekly, I want to check quarterly, I want to check monthly. You want to check your portfolio periodically. Just if there is need to change anything, then you can make changes accordingly. So market condition changes and a lot of things changes market. A news about the sector can change the market. Any market condition, something can just happen and there might be a need for you to readjust your portfolio. So you want to check your portfolio maybe weekly, monthly. Yeah, thank you, David Alabi. The stock market is meant to transfer wealth from the impatient to the patient. Thank you, Hifi. The stock market is designed to transfer wealth from the impatient to the patient. So make sure if you're in the stock market, make sure you're a patient investor. Don't panic sell. Those all right. So having mentioned this, I said earlier that when I was in 200, 300 level before the market crash came in 2008, that I didn't have enough information. And that leads me to the last I'm going to be talking about today. This doesn't mean that this is all we have, but this is just all we talk about today. Now, that leads me to this: failing to educate yourself continuously. If I have this knowledge, if I have had this knowledge I have now at that time, the story would have been different. But after that 2008 crash, I left the stock market. I just left it for some time before I came back to it. Thank God we are back. Thank God we are here. And that's the reason why it looks as if I keep coming and I want to educate people, because I want you to know what I know. So, failing to educate yourself continuously. Many investors stop learning after buying their first stock. So now you have bought Aradel. Now you have bought First Bank. Now you have bought GTCO. You just leave it there like you bought some, like you paid money into your savings account. No. Check. If there's a news on GT, you want to read up the news. Now that's why I said that over diversification is dangerous. Imagine you have 40 stocks in your portfolio. That means each news on those 40 stocks, you need to keep checking. Each fundamentals, you need to keep checking. In fact, you will miss out on some of those things. So you want your portfolio to be few, your stocks to be few, but heavy across different sectors. So let me come back to education. So after buying your first stock, your second stock, your 10th stock, still don't stop there. Check their fundamentals, read up news about them, get information about the stocks, know what is happening, check when you have the swings. Stock market involved and new risk opportunities emerge. So there might be risk, there might be opportunities. In fact, you might need to buy more. But if you don't check, if you don't educate yourself, you don't know when you should buy more. You don't know when you should let that stock go off your portfolio. You don't even know when to count your losses and even sell at loss and put that money in another stock, in another sector. You don't know. Why? Because you are not educated. So get information. Always think like the owner of the business. If you were the owner of the business, will you continue to check? Yes. So most of us will take the money from our businesses, we put in the stock market, which is another business. We keep checking our business and fail to check this. Educate yourself. Know what you are buying. Know about it. Know what they are into. Somebody asked about VFD the other time, was asking me that, can I talk about VFD? The matter is, do you even know what VFD is into? Do you know the sector he's in? Maybe somebody just mentioned VFD, you just bought. Get information. Know why you're buying. Know what your is. Know what they are selling. Know what they are into. Is it a conglomerate? Is it just one? Is it just one thing they are doing? Are they just selling gala? Are they just selling ice cream? Do they have many products? You want to find out so that you know where you stand in that market. So I said, stay informed, follow market reports, read news, attend seminars, attend webinars, just like what you are doing now. I'm sure that many of us, you have gained more insights tonight. You have learned more tonight. And I want to see in the comment section, I want to see if you have gained something tonight. Tell me, I've learned something, I've learned a lot, I've gained insights, I've gained knowledge, whatever it is for you, I want to see in the comment section. So attend webinars, gain insight from experts, read earnings releases. So when they release their results, first quarter results, second quarter results, read it. Compare first quarter to second quarter, compare third quarter to fourth quarter, so that you can make decisions from it. Take courses. Now, I see a lot of people not wanting to take courses. They want everything free. Yes, you can get free information online, but can you can you match the information together? The time you take to begin to move from one to another, can you just, when you have spotted someone that you know that, okay, this person seems to be an expert in this field, can you just pay for courses and learn? Just learn, sit and learn. If it takes to be mentored, can you go for mentorship? If some of you don't even have the time to sit and be checking out all these things around, just learn. So take courses, read news, Read their reports, check the company's performance. I said, remember, ignorance is more expensive than any paid education. Ignorance is more expensive than any paid education. Thank you, Adams. Learned a super information. Samuel, I gained a lot. Uchena, I have learned a lot tonight. Thank you, our son. Thank you, Dauda. Thank you, Nicolene, Franklin, and Il Crown Lofty. Yes, Il Crown said, how many stock is good for 50 million naira portfolio? Okay, we'll come back to that. I have two questions. Please, if I don't answer your question, when I get back to question and answer, please just retype for me so that I can answer the question. So, ignorance is more expensive than any paid education. There's a saying that says, you think education is expensive, try ignorance. Ignorance is more costly. Ignorance is more expensive. So go for knowledge. Learn. Don't put your money in the stock market when you don't know about it. The money you will, the time now, it's not even just money, your time. When you put the time into it to learn about it, it saves you. When you get information, read companies' reports, attend webinars, pay for courses, take mentorship. All these things helps you to be grounded, and what you will have lost in the stock market, you will have gained what you will have lost in the stock market if you don't pay for those courses. You will lose more in your stock market, more than what you will have paid. And you stand a risk, you are more at risk because you don't know what you're doing. You are not doing it with a goal in mind. You are just doing it as it comes. So get knowledge. I don't want to dwell on that. I want to start taking questions now. So let's move to question and answer. So to learn more about investment, I say, and finance, I said go to www.chifacademy.com.ng. So if you want to learn more about investments and finance, go to chifacademy.com.ng. Now, if you have not subscribed to my channel, you want to subscribe because I promise you, you will learn a lot. I'm not here to create content. I'm here to give you valid information. I'm here to educate you. I'm not just going to be releasing content. It's so that you can take immediate action. I'm going to be teaching you enough to take action, not just halfway. No gatekeeping. So if you have not subscribed, you want to subscribe because there is still more to learn. There is a lot in the box that is yet to be unboxed. So please follow, share the channel with everyone that asks you for urgent 2K. Everyone asking you for urgent 2K. Share with them. Let them learn and also grow their money. They will not continue to come back when you have taught them. So don't just give them fish. Teach them how to fish. They won't come back to you for your own fish. All right. So now I would like to take questions before we close. Somebody said free information is limited. Thank you, which is true. Free information is limited. So don't be afraid to pay for information when it's necessary. Knowledge alone isn't power, but applied knowledge is a game changer. You nailed it. Lincoln has nailed it. It's not just gaining knowledge, but are you acting it? Are you taking action? Now, I've told some of us, don't panic sell. Don't run after a moving train. But maybe tomorrow again, they see a stock that is rally, they will still run after it. If you have not applied the information, you are not different from someone that has not attended this webinar. So take action when you learn. Take action. So applied knowledge is a game changer. Thank you very much. Someone said, I currently use Bamboo app. I have two questions. Okay. I don't use Bamboo app, but if it's a question I can answer, I will answer it. But if I can't answer it, I would like those that also use that app to help us with that question. All right, so please, can you begin to type in your questions now? Let me see if I can take the questions that people have asked already. Don't forget, yes, don't forget, the stock market is designed to transfer wealth from the impatient to the patient. Oladimeji Benjamin said, because I'm getting closer to my retirement age and I'm contemplating on dividend paying stocks, e.g., NIDF. Yes, a solid stock that pays dividends 4 times in a year. So NIDF is a solid dividend stock. So you're making a good decision there. Please, if I've not taken your question, can you help me repeat it? Just peradventure I missed out on the question. I'm looking for a question that somebody asked. Has it been deleted? Oh, okay. So Lot said, how many stock is good for 50 million naira portfolio? Okay. So now when you say how many stock is good for a 50 million naira portfolio, this is quite relative. If I tell you 10, I might tell you 10 stocks, I might tell you 20 stocks. It's still a little relative. But you decide, do I want to buy just 10? Buy 10 across few sectors, thinking of banking, thinking of oil and gas, thinking of, let's go back to some of, thinking of the food sector, thinking of the industrial sector. If you find a solid insurance sector, think of maybe just one or two. Don't go and spread yourself. I don't want to mention stocks now so that people will not see it as stock recommendations and people that are watching after will just run and buy this stock. So I don't want to mention stocks. So you can look at 4 or 5 sector, look at aviation. One aviation we have NACO and one other one. So decide on your own. I want to go in 7 sectors, 5 sectors, sectors, one or two. Banking sector, maybe 3 stocks because the volume is reasonable enough to have up to 3 stocks in the banking sector. So look at banking sector. Look at why you are investing. Your reason for investing can also determine how well you'll be able to split this stock. So once again, I said, go and watch this video. This video is going to help you to make decision. I just dropped that video with Fem with Mayor now. Go and watch that video. That video is going to help you to make a solid decision. So Lofty, I want you to take this decision. I don't want to just say go and buy 10 stocks, go and buy 20 stocks. But even if it's just 10, keep those 10, check the fundamentals, stay invested. Now, the beauty of keeping few stocks, let's say you have 10 stocks, 10 or 12 stocks. So the beauty of having like 12 stocks is that the units are more instead of buying small units in even in either in the same sector or different sector. You have more units. So when that particular stock is moving, there is a significant move in your portfolio. And for somebody like you, I'm sure that you don't want to gamble around certain volatile stocks so that you don't miss out. Even if you want to do volatile stock, you are looking at maybe 10 or 50% of the overall volume so that peradventure there's a move, you can also benefit from that. And you can even split. You can have maybe 40 million invested, 10 million naira traded. So when you make um, profits from your trades, you move it back into your investments. Now, I'm just telling you different things, but sometimes to give this kind of counsel, I have to sit with individual clients to hear them out. My job is just like that of a doctor. I need to hear you out. I need to listen to you to know what to recommend, to know what to talk to you about. So that's why I can't give a straight up answer. But decide. It could be 12 stocks, it could be 10 stocks, it could be 15 stocks. You don't want to go and do 30 stocks. You don't want to do 30 stocks. You don't want to do 25 stocks in your portfolio. Sit in a few, 10, 12, 15. Decide. Depending on those stocks you have made research on, and you say that, okay, I won't let go on 1, 2. I'll stay in Zenith, I'll stay in UBA, I'll stay in Haradel, I'll stay in USDN, I'll stay in Dangote Sugar, I'll stay in MTN, I'll stay in Dangote Cement. So you want to check, okay, I'll stay in these ones. Then banking sector 3, oil sector 1 solid one, consumer goods sector 2 solid ones, industrial sector 2 solid, aviation 1 solid. So make that decision and come back to share your testimony as early as January, February. I would like to I would like you to share your testimony with us. So somebody said, how first is how How do I claim my dividend on bamboo? Okay, so let me know, is it a dividend that you of a stock that you have bought for so long? Have you dematerialized that stock? Is this a dividend? Is it a stock that you bought so long and you have not dematerialized, or a dividend that you bought on bamboo and that particular stock has not, that particular company has not paid you? So let me answer the second one. So while I wait for you to answer that, so if is that you are already registered on bamboo, you bought that stock on bamboo and your dividend has not been paid, what you need to do is look for the registrar. Let's say, for instance, now Zenith, Veritas is the registrar for Zenith. What you now do is write a mail to Veritas, tell them, giving them your CSCS and your CHN, tell them that so your dividend has not been paid and you're expecting payments. Your name, your CSCS, your CHN. So with that, they can know, even your stockbroker, the stockbroker you're registered with, they'll be able to know from your CSCS and CHN, so they can process your dividends. If for any reason you don't get a response from them, write another mail and copy SEC, that's Security Exchange Commission. Write another mail and copy the Security Exchange Commission so that they can take immediate action on giving you your dividends. All right. So let me know if I answered the question. From that question came from A and G Prints. So let me know if I answered your question. Okay. Joseph said, overfed by knowledge. Bravo me. Yeah, good. But make sure you don't have constipation now that you're overfed. I want you to let that information, make sure it's useful for you. Somebody said, what is happening to First Bank? Any idea? Okay, so nothing is happening to First Bank. First Bank is just taking its time. First Bank at the beginning of the year was around 25. In fact, you could buy for 23. Sometimes within the year, it came down, it's retraced 23, 25. That stock now is around 32 naira. So imagine you bought it at either 23 or 25 and it's now 32. That's still about 7 naira to 9 naira profits. So that stock is not done. That stock is not done. So nothing really is happening with First Bank. Okay, please repeat your questions. Peradventure, I'm missing out on your questions. Just repeat your questions so that I can take your question. Somebody said, how many stock is good for a 50 million naira portfolio? Okay, so I've talked about that. That you decide depending on the sectors. Banking sector, 3 stocks. Aviation, 1 stock. Oil and gas, 1 stock. Industrial sector, 2 stocks. Food sector, 2 stocks. So I'm not saying this as a recommendation now, this is for educational purpose. So now when you have made that decision and you check the fundamentals, you can now decide, I'm staying on 10, I'm staying on 12, I'm staying on 15. Don't spread yourself too thin. Don't spread yourself too thin. Coach, do you think Zenith Bank will go below 66? How much is Zenith now? Zenith, I think if you find Zenith at 66, this is what I think you should do. If you find Zenith at 66, you can split your money into two. Buy at 66, and if you have a dip later, then you can buy. But if you find Zenith at 66, I think it's a good buy because Zenith has gone as high as 70, 77 or thereabout 75 this year. This year recently. So please, if you find Zenith at 66, I don't think it's a bad buy. Whether it will drop below 66, I cannot tell. But just peradventure it drops below 66, maybe between now and November, you can now average down. You can now buy more. Don't forget that one of the things I told us that is timing the markets. If you are long term, at 66, Zenith is not a bad buy. Then if you find it below 66, you can now buy more. And if you never find it at 66, then you still buy. So you cannot always time the market. Like I told us, that is one of the mistakes we make in the stock market, always timing the market. Please, can you list some of the industrial stocks and difference between financial service stocks and banking stocks? Okay, so when you say financial service, now when we say banking, everybody knows that banking is bank based. So when it's now financial services, it means that they offer finance from the banking sector. For instance, you have, if you look at a stock like UCAP, a stock like VFD, Those are financial services. But when you talk of bank, you are talking of bank itself. Zenith Bank, GT Bank, Fidelity Bank, Stanbic IBTC, um, please mention those banks for me again. So you're talking about bank per se when you're talking about banking stocks. But when you're talking about financial services, they are all other stocks or companies rendering financial services different from the banking sector. Okay, coach, please, why Fidelity Bank is being stagnant for so long? Mm, why is Fidelity Bank stagnant for so long? Oh, I can't tell precisely why that has been, but if you are in that stock, I think it's a time to be patient. You don't want to hold that stock, and at the end of the day, somebody who has not held the stock long is now benefiting from what you have held. So it's like you're holding a bag for somebody, and in a short period, you just hand over the bag and the person gets the reward. So it's like you took the first leg to the fifth leg when you have only seven legs, and you handed over the baton only for the last person to take the baton to win the race. So if there is fidelity, you might still want to exercise patience for that stock to move. AK says Zenith Bank was 66 yesterday. Yeah, yeah, but Zenith Bank did not close at 66 yesterday. Let me check. I'm not sure Zenith Bank closed at 66. Oh, I don't have it here. I'm not sure Zenith Bank closed at 66 yesterday. Let me see if I can access that quickly from here and check how much Zenith Bank closed yesterday. I think Zenith Bank closed around 60. I'm going to check that right away now. Let me check how much Zenith Bank closed. So let's see. Just I'll do that in less than a minute. So you all should just hold on for me. Oh, Zenith Bank closed at 69 yesterday, but the last price was 66 now. Let me check the trades. I want to check all the trades that happened in the market yesterday. Let me see if I have access to it. Zenith. Okay, here we go. So, people were able. Zenith Bank closed 66 naira yesterday. Wow. So people bought as low as 65 naira 20 kobo. I'm seeing 65 naira 20 kobo here. So some people were able to buy Zenith 65 naira 20 kobo. Okay. So now let me also give us these hints that many times on Fridays are good days to buy in the stock market because people usually sell off on Friday. So sometimes, many times on Friday, you find buying opportunities for stocks that are on your watch list. Now that reminds me that as an investor or a trader, you should have stocks in your watch list. The stocks you are planning to buy. If you maybe it's 10 stocks, 8 stocks, 5 stocks, there are stocks you should be checking from time to time. It might be daily. You are checking what is happening so that you can decide on, okay, now is the time to enter. Now I don't want to enter. Now is I no longer want to enter. I don't want to jump on a moving train. You don't just come into the stock market and just feel like, okay, today I have money, I'm buying stocks. No, you should have stocks that are on your watch list. If you check my account, you'll see stocks that are on my watch list, stocks that I'm watching and I'm checking, okay, this is my buying region. If it comes here, I buy. If it doesn't come here, I forfeit it. It's not a do or die affair. So you want to have stocks that you are watching on your you want to have a stock watch list. You want to have stocks that you're watching. I know I can do more checking on this, but it's going to disrupt us if I do that now. So having Zenith at 66, somebody bought at 65 naira 20 kobo. It means that maybe not, maybe because it's Friday and Friday is always a good time to buy stocks on discount. So maybe that was why it came so low. But let's see what happens Tuesday. Maybe it returns to the 17 naira region, or in fact, it might even be now we have it at 66 naira. On Monday, we might not even have anyone ready to sell for 66 naira. Who knows? So let's see what happens Monday, Tuesday. Maybe it goes up, maybe not. We don't know. Can I benefit from the right issue with my bamboo? If it's a stock, your question is not complete. But if you already own that stock, maybe it's VFD, TIP, Champs. I know those are the stocks that are doing their right issue now. TIP, Bamboo, VFD. I think Presco should also do their own. We are waiting. If for any reason you hold those stocks and you want you want to take up your right issue, then you can use your bamboo. You can use any stockbroker that you're already registered with. You can take up your right issue with any stockbroker that you're already registered with. So that should answer your question A and G prints. Now you can only take up right issue if you already own that stock. That's what it means by right issue. It means you have a right to the issue because you own the stock. Okay, so you already have it. Yes, so you can take it from Babu. You can take it from any stockbroker that you use that you are registered with, either Bamboo or any other stockbroker. All right. Somebody says Zen Bank closed at 66 yesterday. Yes, thank you, AK. Yes, I just confirmed that it closed at 66 yesterday. A&G said, how do I go about it? Just reach out to your stockbroker, tell them you want to take up your rights issue, and they will send you the form to fill. And that's it to this. All right, everyone. Since we have been able to answer all these questions, if I find any other question, I will answer. Otherwise, we'll call it a day from here. So before we close, while I wait to see if we have more questions, before we close, can you tell me one thing you learned in today's webinar? What stood out for you? Let me see in the comment section. So what stood out for you in today's webinar? Very quickly before we close, what stood out for you in the webinar? Let me see that before we close. And let me also let us know that we have a WhatsApp group, a free WhatsApp group where we share insights once in a while. And we also answer a few questions and we release daily reports. So if you'd like to join, let me see, can I drop that now? Okay, so let me see if I can drop that now in the comment section while I wait for us to tell us what we learned in today's webinar. So while I wait to see what you have learned, let me pick that number very quickly. I'll drop it in the comment section. Then you're free to join. Everyone is free to join that group. All right. Somebody said, "Can I?" Okay, I've answered that. Yes, you have. You okay? How do I do that? Okay. Thank you, oh, Franklin. Thank you very much. He said, "Thank you, coach. You're welcome, Franklin." So he said, "Do not time the market." Thank you very much. So you have learned that don't time the markets, especially when you're a long-time investor. Just buy. Don't continue to wait until it dips. And if you're in doubt, if you don't know what to do, if you're in doubt, split it into two. Buy one now and wait. If it now dips further, then you buy. And if it doesn't dip further, you still buy. So with that, you don't risk buying either lower or too high. You don't risk buying either too low or too high. Oh, he said, what happened with livestock? Is not moving since March. Yes, that's because they released a poor result. So the market is punishing them for that result. That's why that stock has not moved. So whenever I want to buy any stock, it will be on Friday. Oh, it doesn't have to be Friday. So what you have to do is instead of waiting till Friday, check that stock from Monday till Friday. So Friday, you are now able to make a decision if you want to buy or you don't want to buy. Do you understand? So don't always wait till Friday. Check it from Monday to Friday. Check the prices is closing. Check the trades of that day. How much people bought. Just like I check the trade now, I can see all the amounts people bought. So you want to check the trades for that day and now check against that Friday date. But don't forget that time in the market always beats timing the market. Oladimi said, I learned that overspreading is bad. Yes, don't overspread. And at the same time, don't you want to diversify, but you don't want to over diversify. Don't add too much stock in your portfolio. Yes, don't over diversify. Doing research diligently. Thank you. Somebody said which sector will boom in the third quarter and fourth quarter. I can't tell which sector will boom in the fourth quarter or third quarter, but I know that the fourth quarter is holiday season, so we might just have something around the aviation sector. So that's an hint for you. The fourth quarter, there's going to be a lot of exchange of gifts. So you want to look at those companies into groceries, food. So that's an hint for you. But don't forget, I said this is for educational purpose. So you want to do your own research. Diversify, but don't over diversify. Thank you, Fola. AK, I learned that stocks are cheaper on Fridays. Yeah, over time, we have discovered that stocks are cheaper on Fridays. Like you get some discounts on Friday, but it doesn't mean that you always have it that way. It could just change a pattern for a particular stock you're watching. So you want to check from Monday till Friday. Oh, somebody said is African Prudential shares a good stock to like that's one of those financial service sector also. Yes, it's a good stock to hold, but at the same time, do your own research because you are the CEO of your portfolio. So from here, I would like to call it a day. Thank you, everyone, for coming. Thank you. If you didn't show up, I won't be here. So thank you everyone for showing up straight 2 hours. And I can see that almost everyone that started with us waited till the end of this session. This is to tell me that you benefited a lot from this section. Just like I said earlier, also that I'm a portfolio builder, and if you think you might want to speak with somebody who can help you build your portfolio or assess the one you have done already and make readjustments to suit your goal, join the WhatsApp group and you'll be able to reach out to me personally. We'll discuss it. However, this is not free, but is worth every penny you pay for it. All right, awesome. I have learned to be patient in the stock market. Very good thing. Patience always rewards. Thank you, Likoni. Thank you, everyone. I appreciate you. And we'll see next week, Saturday. Do have a nice night and have a nice weekend. Good night, everyone. Oh, you're welcome. Good night, everyone. Good night, good night, good night.